updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long on Bloomberg. The Dow, the S&P, NASDAQ, all in the red. We've got 38 minutes to go ahead of the closing bell, with the S&P now down 54, a drop of 1.4%. What a day, with the Dow down 345 now, a decline there of 1.1%. NASDAQ down 198, a drop there of 1.7%. Jobs Friday, but the focus is on banks. We've got the 10-year yielding 3.70%, the 2-year 4.60%. A renewed bout of volatility rattled markets around the world as SVB Financial Group's turmoil spurred concern about further distress in the banking industry. Spot gold up 1.9%, $18.64 the ounce. West Texas Intermediate crude up 1%, $76.46 a barrel. Bitcoin right around the 20,000 level, slightly below now at 19,987, down 1.2%. So where does this morning's better-than-expected jobs report leave the Federal Reserve? Tiffany Wilding is North American economist at PIMCO.
The bottom line is, it's a tough job for the Fed right now. I think they kind of set out a plan for going 25 basis points to kind of weigh the different risks. They don't want to tighten too much, but they don't want to tighten too little. That still seems like a reasonable plan for me.
The FAA says Boeing can resume delivering 787 Dreamliner planes as soon as next week, after resolving an issue that led federal regulators to issue a halt last month. After earnings, we've got Oracle shares trading lower by 3.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Jess Metton here on Bloomberg Business Week on this Friday. And all right, folks, the other big headline today. U.S. payroll is up in February by more than expected, while a broad measure of monthly wage growth slowed, offering a mixed picture as the Fed considers whether to step up the pace of interest rate hikes. So many questions. All right, with what she is seeing, let's bring in Amy Hunter-Glazer, Senior Vice President at the Global Staffing and HR Services company, Adecco. She's with us via Zoom in Florida. And then here for our Jobs Roundtable, Bloomberg News economics editor Molly Smith. She's here in our Bloomberg Interactive Broker studio. All right, so Molly, lay it out for us. It was a mixed batch of data, right, from the government.
Totally, which is why I hesitate to take a side here. So I'm going to lay out the good and the bad. So on the good side, we have this headline number of payrolls growing by more than 300,000 last month. That's exceeding almost every estimate in the Bloomberg survey and continuing this streak that economists have now gotten it wrong for 11 straight months to the downside. So we are still growing far more than what most forecasters would expect. You may have seen the unemployment rate rose, but actually for a, quote, good reason. It's because more people actually came into the workforce, so the participation rate rose, and also the share of those people who are employed also rose. So it's not just that they are looking for work, they actually have jobs. So those are all good things. Another thing where there maybe needs to be a little caveat is that we're hearing that a measure of wage growth slowed, which it did, for average hourly earnings for all employees. But if we look at a smaller subset that is just looking at what's called non-supervisory workers, as in the majority of us who are not in management positions, rose a lot. So let's just
market's still hot, jobs are still out there, employers are still fighting for top talent.
Well, it's interesting. You heard, Molly lay it all out. So it sounds like tight labor markets still. But I am also curious about, as we dig a little bit deeper, what about the wages that are being offered? Are companies able to dial that back a little bit and not have to compete so much when it comes to wages?
I still think we're seeing the most success in employers who are paying up in that 75th percentile range. Especially as it relates to that non-desk workforce. What we are seeing a little bit of a slowdown.
What does that mean? Is that like the hospitality, leisure?
Yeah,
okay.
Our warehouse, transportation, those folks. What we are seeing is a slowdown on workers that are transitioning from one job to another, getting those great wage gains that they have seen for the past 12 months. So signing bonuses starting to stall just a little bit, retention bonuses. are kind of going by the wayside. So we're seeing some of those other financial incentives really shift, but that base wage hourly rate, we're still seeing the candidates are taking advantage of.
Molly, I was curious about what kind of impact this report will have on Fed policy, because we didn't see a big revision downward for those January numbers. And still, even though we saw a bit of cooling, I mean, seemed like a still pretty strong, solid report, right?
Yeah, and I'm laughing here because I wish I could give you the answer, and I think that's what we all want to know. And I don't want to steal Carol's thunder here, but she had alluded to a survey that she did on Twitter on what this means for the Fed.
Oh, yeah,
Does it mean 25, 50, or depends on CPI?
I said Fed's next move, 25, 50. Most people said 50 basis points.
Really?
Over 61%. 23% said 25 basis points. And then I said up to CPI, 15%.
Okay, well, I'm going to go with the last one to give myself the most wiggle room here. I think that's the most prudent thing to do. And just given like what I was saying before, all of these caveats that it's really just tough to take this at the face value because on the one hand, the Fed's going to see these two, as you mentioned, Jess, back-to-back months of really strong job gains, and but then on the other hand, they see moderating wage growth, which is great, but there's this subset of the population where they're still experiencing really strong wage gains, and it's in the service sector where the Fed is most concerned about wage pressures.
All right, that's good. But Mike made the point too, and this speaks to something, I feel like, Amy, that you were talking about. Mike McKee earlier said that where the growth was hospitality, right? I think food services, things like that. And that tends to be lower wages versus manufacturing, which saw some declines, which tend to be higher wages.
That actually, that's actually a good point, Carol, because we did break out in some of like where this was a mixed bag, the good and the bad, that what we look at in what's called the diffusion index, it tracks like the breadth of jobs gains and how widespread the employment growth is across industries. It's actually pretty narrow right now. It fell last month to the lowest level since the onset of the pandemic. So that shows you that the job gains were really just concentrated in a few industries like leisure as well as retail and healthcare.
Amy, I was curious about what are you seeing when it comes to the type of benefits that talent is trying to seek in these new type of roles, when we are debating a lot about what the wage picture looks like when it comes to the Fed and what that means for them?
It's all about flexibility. So they're looking for employers that really allow them that opportunity to focus not only on their financial well-being, but their mental well-being and health well-being as well. So we're seeing flexible schedules, paid time off, any additional perks having to do with physical activity, yoga classes, things of that nature. So wage continues to be number one, but a solid number two behind that is how that financial piece gets balanced truly with your health and well-being.
I mean, that sounds like that's still challenging, right? That'd still be challenging for the Fed then, this dynamic.
Yeah.
I want to bring up one more question for you as well, if that's okay. There was one thing that we saw, that the average work week was shorter in February, and not a ton, but normally this is what we can see as a potentially worrisome sign because employers tend to cut hours before they cut staff when demand wanes. So I just want to know in your work if you're seeing any of the impacts of that come up.
We're really not seeing that much of an impact as it relates to hours worked. Maybe a slight reduction in overtime, but I actually attribute that to we've seen some relief in a couple different areas on supply chain issues. So I think it's more of a rebalance where we've just had for the past this heightened sense of we've got to get product out the door, and we've had a lot of overtime that we're just balancing back to a new normal.
Hey, I do wonder, Amy, and tell me if this is right, guys. Fed swaps were pricing in a Fed cut now again later this year. All right, so they are still. Amy, so are the companies that you're working with or hearing from, anybody, though, talking about the potential for a recession that could be problematic or a slowdown next year or later this year?
What I'm hearing from most employers is they're cautiously optimistic that, this may be a tiny slowdown, but that it will rebound very quickly. So I really am seeing a lot of companies hold on to their labor in an effort to avoid, even if there's, a little bit of disruption, they don't want to be faced with a talent shortage in the future. So I think lessons learned from the pandemic are at play again today as they're kind of stockpiling their workforce on the back end.
All right, so we need to look forward. CPI, yes. That's our next stop. Molly, let me get your thoughts first.
Yeah, CPI, the next big one next week. We also have PPI, which is Producer Price Index of wholesale inflation as well as retail sales. So, yeah, these are really the next big data points, the last ones that the Fed will have before their meeting the following week. I think taken together, all of this probably, and of course in the context of SVB, you really can't ignore that at this point, is probably still tilting in favor of the 25 basis point hike as opposed to 50. So it almost in a way seems like what Powell was talking about earlier this week, opening the door to 50 is somewhat old.
Right.
It's very much old news at this point. I mean, I don't know. To me, that just seems like that would just really cause more problems than do good.
Amy, saved you 15, 20 seconds. Any thoughts in terms of wage inflation and what we might get?
I think we'll wait and see. I think we'll continue to see just some modest growth over the next couple of months, but I don't anticipate any huge surprises.
All right, going to leave it on that note. Our thanks to both of you. Amy Glazer, Senior VP of Adecco via Zoom out there in Florida, and Molly Smith right here in our Bloomberg Interactive Brokers studio. She's economics editor at Bloomberg News. I also asked the Twitter world, what would you lead with today? I said cooling wage inflation, bank contagion, or other. Overwhelmingly, they said bank contagion, 77, almost 78%. All right, let's get a check on world and national news. Off to our 99.1 newsroom in Washington, D.C., and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is hosting European Commission leader Ursula von der Leyen at the White House this afternoon. Before their closed-door meeting, von der Leyen said Ukraine would be one of their topics of discussion.
We are, as partners, strongly supporting together Ukraine. That fights for freedom and independence. We're making Russia pay for its atrocious war.
Von der Leyen thanked Biden for helping deliver more energy alternatives to Russian oil. The two leaders are also trying to avoid a trade clash after the U.S. pushed through a subsidies package to bolster development of clean technologies. Two former prosecutors who worked together for years at the Justice Department are finding themselves on opposite sides of probes into Donald Trump. We get more from Bloomberg's Jill Schneider.
James Trusty and Jack Smith are now potential adversaries in what could be the nation's most politically incendiary federal case. Smith is poised to recommend to Attorney General Merrick Garland whether to indict the former president for mishandling classified documents or in connection with efforts to overturn the 2020 election. Trusty is part of Trump's legal team. Meanwhile, a federal judge has ruled that the so-called Access Hollywood tape, where Trump was caught on a hot mic making crude comments about women, can be played at the upcoming trial in a defamation case brought by a New York author who claims Trump raped her in the 1990s. Jill Schneider, Bloomberg Radio.
Pfizer says the FDA has approved its migraine nasal spray Zavegapant. It's marketed under the name Zavspret. The company says it can effectively mitigate migraines in adults with and without an aura within 30 minutes. And now the latest from the Players' Championship. Chad Ramey is still the leader. He is 9 shots under par. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We check markets all day long here on Bloomberg, and this update is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The sacrifices you made keeping your employees on payroll during the pandemic are not forgotten. Check the potential refund your small to medium-sized business may be eligible to receive through the Employee Retention Credit with no upfront costs. Get more at getrefunds.com. Now let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. It's another ugly day for stocks as SVB Bank fails and the FDIC takes over. The Dow is currently down 441 points. S&P's dropped 67, and NASDAQ is down by 229. The U.S. 10-year yield plunges to 3.69%. Gold is up 36. Energy is climbing, and Bitcoin is down by 1%. All of the main 11 S&P sectors are trading in the red, and leaders to the upside in the Dow, Intel and JP Morgan, while Caterpillar fell 5.9% and led to the downside. Among the bank sell-off, Signature Bank fell 23%, Schwab fell 11%, and the trading in First Republic, that had a trading range of 45 to 95 a share. Wrapping things up, Oracle fell 3% after earnings. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. Have a great weekend. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Have to do a double take.
All right, everybody, about 17 minutes left in today's trading session. I think Jess was just saying double take because there are some numbers that are being thrown at us when it comes to the markets that kind of get you like, wait, what? Carol Master along with Jess Metton. You know, Tim is on leave. And as we said, we're counting down to the closing bell here. We got a lot going on. So let's get to it with Christopher Zook. He's founder, chairman, and chief investment officer at Kaz Investments, joining us on the phone from Houston. Christopher, good to have you here with us. We've had quite a market reset, I think it's safe to say, over the last couple of weeks. So we've had a bank failure. We've actually had two this week in terms of regional banks. We've got Fed swaps fully pricing in a quarter-point rate cut by year end. That happened today. We've got lots of volume amid the volatility and downward swings that we're seeing on equities. So how do you describe the market environment right now, and how confident do you feel about predicting where we are 3 months from now, 6 months from now?
Well, thank you for having me. And what I'll tell you is that anybody who is bored, they're now wide awake. It has become a quite interesting market environment. And just in the last 24, 48 hours, it has shifted quite a bit more. So to answer your question specifically, you know, it is very difficult to focus out 3 to 6 months just because there's so much noise. We have a saying as a firm, which is be careful not to look too much at the trees, but try to look at the forest above. Here's what the forest is right now. The Fed is in a box. They're going to have to raise rates more. They're going to have to do it probably longer. And so as a result, it's going to make it much more difficult for investors to just ignore that. And what I will say is that there's two types of recessions. There's episodic recessions caused by events like COVID, and there are manufactured recessions where the Federal Reserve simply says, we got to put the country in a recession to tamp down inflation. We haven't seen that since 1982, and most of the people picking stocks in 1982 or picking bonds in 1982 aren't in the business anymore. And so as a result, nobody knows the playbook really to use in this environment. And that's what's really going to set the tone, is how much does the market begin to anticipate 24, or do they really just truly not understand what 23 is going to look like for the rest of the year?
I know your firm provides private credit to investors, and that's something that's really important. What are you seeing there? What is that telling us right now?
You know, it's interesting because in the private credit world versus the public credit world, there's actually a fairly significant amount of stability compared to what might be expected at this time in the economic cycle. So we invest in a lot of different areas of private credit, and so you really do need to dig into the details of a specific segment or a specific sector. But overall, we're not seeing distress because more or less companies have had better balance sheets as they've gone into this recession. They've had better liquidity position, but, and this is the big but, is that we have a wall of maturities that is going to happen between 24 and 26, and now interest rates are much higher, margins are getting compressed, and so we do think there's going to be some fantastic opportunities in the distressed debt landscape coming in over the next 18 to 24 months as that reset does occur, so we're building a war chest to take advantage of that.
What are those opportunities specifically?
Well, I mean, as you see spreads blow out, the interesting thing about this cycle, going back to my point about different playbooks, you know, when you think about COVID, spreads blew out immediately. High yield spreads went from whatever it was, 500 basis points to, 1,500 basis points, just round numbers. And so what you saw is this immediate reaction of fears of contagion and how this was going to drive, businesses out of business were being taken, to use a not a great analogy there. But
a lot of paper cuts can add up to some serious pain. So I am wondering, just to push you a little bit further, I mean, in terms of where the distressed credit opportunities might be, are there certain industries that you think are particularly vulnerable?
Absolutely, we do. And we think that anything in the industrial or anything that doesn't have material pricing power, when you look at a stagflation environment, which is what we believe we're in and going to be in for a little while, it's those companies that have the ability to pass on price increases to their customers that are going to be able to be more resilient. So if you see spreads blow out I'm going to just use industrials because I already said it. If you see that blow out to where you're getting 1,000 or 1,200 basis points on top of a Fed funds rate of 5 or 5.5 or 6, now you start talking about really, really good returns. And that's before you apply any leverage whatsoever to your own investment strategy. So we see those kinds of opportunities playing out, as well as in the venture capital lending space. Obviously, forget the whole SVB story today. Just before today, you had this enormous gap between what companies were willing to raise money for and what their needs for capital are going to be over the next 18 to 24 months. Well, if they don't want to do a big down round, then they're going to have to go out and get the money somewhere, and that provides an opportunity for lenders to fill that gap, get very high rates of return, as well as usually warrants or some form of equity. We see that as a great opportunity over the next 24 months.
And you also were speaking about the margins, and obviously that's an important point there. Where are you seeing the companies that are still able to sustain that? And those were, because obviously those are the ones you would think if it's more consumer focused and things like that. But to your margins point, where are you seeing sort of that pressure and then other corners that can withstand that at this point?
So the pressure is everywhere. When we talk to companies all over the world, the one thing that they all say in common is that margins are under pressure because their cost of inputs and their labor costs are all rising, in many cases at a faster rate than they can pass those along to their consumer. So in pretty much every sector, with the exception of maybe chocolate or coffee or areas like that, where they just don't really care if you raise the price by another nickel or another dime, in those particular areas you have less margin compression, but in every other area you have margin compression, which means that as you see that happen, the market is just completely been wishing, and there's the old saying, hope is not investment strategy. The market's been hoping that earnings are not going to decline as much as they typically do in a recession. This is actually potentially worse because you have this big increase in cost inputs. Then you also overlay a slowdown in demand, which is inevitable when you have credit card rates at 19%. And you have subprime auto loans that are obviously at very high rates now because they're floating rate.
Right.
And people are handing back the keys.
But you do wonder, I think, about the auto sector, corporate, or company and real estate. Like there's just things percolating out there. Christopher Zook. Yeah, it feels that way. Christopher Zook, thank you so much. Founder, chairman, and chief investment officer at Kaz Investments on the phone from Houston. You are listening and watching Bloomberg Business Week. Carol Master along with Jess Menton. This is Bloomberg Radio. And in case you missed...
company news headlines on Bloomberg Radio.
It's 3:53 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet. We begin with a headline from the Bloomberg Professional Service. President Biden is poised to further tighten U.S. chip-making exports to China. Among some of the chip stocks that we're following at this hour, Intel up 3.2%, NVIDIA down 2.1%, Advanced Micro Devices lower now by 1.5%. Apple investors re-elected its board, approved its compensation plan, and rejected the shareholder proposals that the company opposed, giving the iPhone maker a clean sweep during its annual meeting today. Apple shares down 1.5%. Bird Global is reporting revenue in the fourth quarter that beat the average analyst estimate, as we hear from Bloomberg's John Tucker.
Charlie, Bird was boosted by the acquisition of its Canadian operations and said that it expects positive cash flow this year. The Miami-based electric scooter rental company, which has struggled for years to reach profitability, expects to achieve $5 million to $10 million in free cash flow this year. Bird, which also sells electric bikes, acquired a Canadian platform partner last quarter that it said added profitable cash flow generating operations in Canada. Since going public in late 2021, Bird has wrestled with local regulations that seek to restrict electric scooters on city streets because of safety concerns and sidewalk clutter. Charlie?
And that's John Tucker. Bird shares BRDS on the ticker, by the way, down 15.3%. Those are the company stories we're following. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, getting ready to wrap up the trading day and trading week. What a week it's been. Just about 4.5 minutes left in today's trading session. Equities just off their lows of the session, as you just heard from Charlie. And then you've got keeping an eye on yields, which have really come back in here on this Friday. You got that 2-year at 4.57, 10-year note with a yield of 3.68. Carol Master, along with Jess Metten. A couple of stories, Jess, on our radar. Can we talk Schwab?
Let's talk Schwab. Looking at this move we're seeing today, I mean, it's had its worst drop in years after what's going on with SVB, really hammering that stock. So you're just seeing how this fallout from SVB is really spreading to other corners of the financial market, Carol.
Yeah, I mean, I'm taking a look at a 2-day drop on shares of Charles Schwab, down about 24%. Interesting day for that name, certainly taking a big hit. Worst 2-day stretch since 2016, and there's an interesting story on the terminal about a block trade JP Morgan was said to be managing. This was a trade worth about $650 million on Thursday before the market opened, and it looks like, ouch. That's timing, man. Or bad timing.
I mean, it seems so painful.
Yeah, exactly. The other story we wanted to quickly just bring to you and mention, startups worried about paying their people after SVB fails. Founders are starting to worry about whether startups will be able to keep paying employees following that failure of Silicon Valley Bank, because apparently SVB helped process some payments for some of the startups.
And that was the big concern there, especially with those types of banks that were exposed towards venture capital type firms. So now that question of how much can this be contained to this one bank and how many others could potentially have that type of fallout, Carol?
Yeah, exactly. And we're learning more about, what Silicon Valley Bank, what did it do within the startup and Silicon Valley community specifically, and we're getting more and more information about it. But it's just another concern, certainly, in terms of the impact of that. All right, just a few minutes left in the trading session. As we said, yields really have been down for most of the day here. Very different, right, Jess, from what we saw earlier in the week when Jay Powell seemed to say 50 basis points, it could happen.
And now that about face where traders are all of a sudden pricing in potential cuts by the end of the year, which would have been unheard of just within the past 48 hours.
Which just tells me that it could also change again. So just going to put that out there. We do have a CPI print next week. All right, folks, a few minutes left in the trading session. Let's head over to our TV colleagues. Jess and I are going to join them because Beyond the Bell starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
It's It's about 2 minutes away from the end of the trading day and the trading week. Kaylee Lyons here with Sonali Basak, counting you down to the closing bells, and here to help us take things beyond the bell with a global simulcast. We're joined now by Carol Massar and Jess Menton, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. And Carol, we thought the most crucial moment was at 8:30 a.m. Eastern when the jobs figures crossed, but really it was later in the morning when we got the news that we had the collapse of SVB.
Yeah, and investors, certainly on the equity side of things, decidedly staying with a risk-off trade here. I thought we might see some buying into the close, but that ain't happening. And Jess, you've got the S&P 500 going below that 200-day moving average. Where that trades from here is going to be critical.
That's really crucial, especially with the S&P 500 below 3,900 and also breaking below that October uptrend line from the October lows. That was something key when it came to market technicians, that there was some bullish breadth there. But now that the S&P 500 back below that, that's a big question mark, especially going into next week, Sonali, with that big CPI report.
The huge CPI report, right? Because we're not going to hear anything from the Fed really until that point in time, unless it's regulatory, frankly, at this point, I would imagine. But listen, the sentiment story here is the big one. This is about a narrative, and this has been a market for a long time now in search of a bull case, and now what we have is more uncertainty about how money flows, regardless of whether we see more stresses in the system or not.
Yeah, so there's questions around the health of the system, but there doesn't seem to be that many questions around the health of the U.S. economy, considering the labor market is still looking strong. So all of that together is what investors had to contend with today. And when you add it all up, it seemed investors really did not like the sum of what they were hearing, because it definitely was a sell risk assets kind of day. As we hear those closing bells ringing, we're looking at a day ending lower by 1.4% on the S&P 500 at 3861 or so. Even steeper losses for the NASDAQ, down 1.7%. The Dow Jones, the relative outperformer here, but still down a full percentage point plus on the day, Carol.
All right, check this out, guys. For the week overall, Dow down 4.4%, down about 4.5% on the S&P, and down 4.7% on the NASDAQ. I feel like, Sonali, it's been a while since we've seen those kinds of drops.
You know, there's been this question about the orderly drop that you've seen in the market when you see financial conditions tighten. And, you know, here you go. This is the sentiment that you're seeing here. Almost every major sector here in the red. But we should see what is falling most. Real estate really ending the day, falling more than everything else, 3.3% nearly on the day. Diversified financials, as we saw many of those regional banks and affiliated kind of firms here falling 2.8% on the day. Materials down more than 2%. Really, we only saw telecom services squeak out a little bit of a gain there, but every major sector really feeling a little bit of pain here.
All right, so let's get to some of the individual gainers. Yep, I actually did find some. And even though the KBW Bank Index was down almost 4% in today's session on those bank worries, JP Morgan Chase was number 2 gainer in the S&P 500, a gain of 2.5% in today's session. So just wanted to throw that out there. I think it was up the most in about 4 months for JP Morgan Chase. Intel was number 1 in the S&P 500. You know, what's interesting is that this stock is on its best 3-day run in about a month, outperforming the NASDAQ 100 for the 3rd consecutive day, so another 3% to the upside for Intel specifically. And that's despite, if you look at the analyst coverage, I mean, these folks don't like, they're pretty bearish when it comes to Intel specifically. Has the most sell ratings in the NASDAQ 100 stock index, but I don't know, it's been bucking the trend. And then mining, take a look at Newmont Mining, up about 1%, largest gold miner in the United States. We did see some movement within this sector, maybe seen as a bit of a safe haven amid the backdrop in today's trading, Jess.
Now, I'm taking a look at what's happening with the decliners, so I have to start off with Signature Bank, taking a look at that stock down just about 23% today. So that's one of the main banks in the crypto industry. Obviously, the sell-off in the bank stocks led by Silicon Valley Bank now for its 2nd day. And also, I have to talk about what's happening with Allbirds. That is a footwear retailer, but that stock, looking at that, almost down 50%, closing down 47% today,
It used to
Carol.
be the shoe of Silicon Valley. I don't know if it is anymore, but it used to be.
It might not be
I have
anymore,
4 pairs
but
myself.
right. Those 4th quarter results, unfortunately, unfortunately missing expectations, so really pressuring shares today. And then I'm going to end on what's happening with the electronic signature platform. If you're looking what's happening with DocuSign, that stock down about 23% today. And also just the company's fourth quarter results, again, they did beat expectations, but they did announce a CFO that would step down. It was actually Cynthia Gaylor, and so she plans to step down later this year. So you are seeing a big hit to that stock today.
All right, so there definitely is a lot we needed to keep attention on in the stock world, but I'm taking a look at this bond market as well, because be it because of the failure of SVB, or be it because of the jobs report we got at 8:30 a.m. Eastern, we have seen massive moves in treasuries, a big bid with yields moving lower substantially all across the curve. On the short end, the biggest move, the 2-year yield down 29 basis points on the day to 4.57. Remember, just 2 days ago on Wednesday, we ended the day at 5.07%. This is a 50 basis point move in just a 2-day period. Meanwhile, the 10-year yield down 22 basis points on the day to 367.96. And as you get further down the curve, the moves are maybe smaller on a relative basis, but still a 17 basis point move lower on the 30-year yield is nothing at all to sneeze at, Shonali.
Yeah, I want to talk a little bit more about some of the ways this day has played out, because the derivative trades, right? You look at a firm like Charles Schwab, which closed down 12%. It's been its worst 2-day drop on record. Remember, the KBW and Bank Index had fell 16%, its worst weekly drop since March of 2020. That was the onset of the global pandemic at that time. And so you have to wonder why there are so many hard feelings in this market when the companies themselves are trying to get out there and tell you we're okay.
I do feel like at this point we're on a search and rescue mission, right? We're going to go through the bank community, go through the financial community, look for exposure, try to really understand. This is where transparency is really important, in understanding that not every bank is the same. Regional banks versus big banks versus just different types. I mean, Silicon Valley, right? This is one that has not been on most people's radar, and yet all of a sudden we know a lot more about it, and it had a very specific exposure. But we've got to look for additional exposure to understand how deep this contagion, if at all, it could be, Jess.
And Carol and I were just talking about where can we pull some of these bright spots from this week. And I was actually pointing out to her earlier about how in the beige book from the Fed on Wednesday in the San Francisco district, they are beginning to see those wage pressures ease. And that's obviously where we've seen the bulk of a lot of these layoffs. So now we're starting to beginning to see some of those rippling effects, obviously coming up close to 1 year of the Fed starting this hiking cycle. Actually, the 1-year anniversary is toward the end of next week on March 16th. So that's something that we are beginning to see some of those signs of inflation easing, again, with that jobs report today, with those easing when it comes to hourly wages.
Okay, so that was today's data. My question is going to be, what does the data tell us next week, specifically on Tuesday when we get CPI? It feels to me that given the fact that the jobs report was pretty mixed, because yes, as Jess, you said, we did have wage pressures easing, but you also had a hot figure on the ultimate headline figure for payrolls, 311,000. That far exceeded expectations once again. So it still looks to be a labor market that's pretty resilient, maybe makes inflation more important.
Let's not forget it's about totality of data, right? As our Tom Orlick of Bloomberg Economics points out, that's the words that Jay Powell used, totality of data. So you do wonder how he looks at all of it.
Yeah, especially when you look at just the predictions coming into that jobs report. That number that we saw had brought us well past the expectation for many economists, let alone Bloomberg's own economists, that that kind of a number would support the case for 50. And you do still have participants in the market that believe that could be the case. Depends on CPI, but again, these lagged effects of the tightening, I think, are also worth noting and less quantifiable.
One other thing coming next week is actually producer prices. Sometimes it falls under the radar when it comes to CPI, but it's really important because the spread between CPI and PPI has improved vastly, and actually in December it turned positive for the first time in 2 years. So usually people look toward that to see where input prices are basically easing before they filter into consumer prices. So that's going to be something else that's going to be of note next week as well.
Got a few more earnings, a lot of things to get through. We're going to be quiet, right, in terms of Fed speak. They're done at this point. I have to say, guys, Kaylee, I put out a Twitter poll, Fed's next move, 25, 50, or up to CPI. What do you guys think the most overwhelming answer was?
Today, I think 25.
No, 50 basis points,
it's
60%.
Still out there.
Really?
It's still out there. We were 30% on our real yield show.
Yeah.
That's 1 out of 3 guests still on 50.
Aggressive, right? That's pretty aggressive.
Indeed. But how much is it about March and how much of it is the fact that we're still now back to looking at a Fed cutting rates by the end of the year, Jess?
Right.
Exactly. So that's really going to heighten up the drama heading into next week with that CPI report, Carol.
That's quite a swing, and that should put volatility maybe perhaps back into the markets, or maybe it'll ease. Who knows at this point? A busy day, guys, and we certainly covered it all. That's a wrap. Our cross-platform coverage. Have a great weekend, guys. Our cross-platform Beyond the Bell, radio, TV, Bloomberg Originals, and of course on YouTube. We call it Beyond the Bell. We will see you again, same time, same place on Monday. This story, because I do feel like, we are just trying to make sense, provide transparency about kind of how we got here in terms of Silicon Valley Bank and really what it means in terms of banks overall. So it was a day, I do feel like, though, Jess, where it was hard to keep up with the headlines, especially when it came to Silicon Valley Bank and what was going on.
Right, and just the spread and how much certain corners, especially in the financial sector, got hit by that. But still, when you looked at other bigger banks, we were talking about JP Morgan earlier, Carol, how when you're looking at that and the big banks holding up better. So if you were concerned about whether or not there'd be any sort of contagion effects here, I mean, if the fact that those big banks holding up, that to me doesn't sound scary. That sounds like something that is a good sign for the economy.
Well, at least they're doing good, right? All right, so let's get to it, because we do, nevertheless, Silicon Valley Bank becomes the biggest U.S. bank failure in more than a decade. So let's get more on that in the overall banking industry. Hannah Miller, she's been busy. Bloomberg News digital currencies and venture capital reporter, joining us on the phone from San Francisco. I'm so glad you're here, Hannah, because I do feel like the San Francisco perspective, the Silicon Valley perspective is so important. What's kind of the buzz there in the Valley?
Yeah, so right now I'm at the Silicon Valley Bank branch on Sand Hill Road in Menlo Park. So Sand Hill Road, we know that's where a lot of the big VCs have their offices. It's been really sad here today. Many clients have come to the doors, knocked, looking for answers. They're closed for business, but they do have two FDIC spokespeople here who are trying to answer questions. And people are very frustrated. They cannot get through to the FDIC. They're worried about making payroll. They want to know when they can get access to their funds and whether their withdrawals will be processed.
And how challenging is it for them to even get any sort of answers there? Because a lot of these questions are so urgent.
Yeah, people are angry, honestly. They have been trying the FDIC number. They have not been able to get through. They've gotten very limited answers. I mean, there was someone here earlier just wanting to get a check, unable to do that. So people feel like that things are just crazy out here, that there's, no real clear narrative as to where this is going. So they're just kind of trying to hold out until Monday. People are hoping that they're going to be able to access funds on Monday.
Yeah, it's interesting. Just as you were speaking, Hannah, I was just looking at my Twitter feed, TweetDeck, and somebody's like, where's Powell? Where's Yellen? Stop this crisis now. Announce that all depositors will be safe. Like, you do wonder... I know Janet Yellen did make some comments earlier and did address what's going on with Silicon Valley, but you do wonder whether or not we're going to ultimately see something from the government. And maybe, at this point, right, officials are they at the bank looking at things and dealing with it?
Yeah, I mean, there are two people from the FDIC, feet away from me in the building. They're trying to, put together responses for people, but honestly, most of the clients I've seen have walked away with more questions than answers.
You know what? Take a step back, Hannah, because I think this is part of the picture. Like, all of a sudden we're talking about this bank that we didn't normally talk to on a day-to-day basis. Talk to us, though, about in Silicon Valley how often people were talking about this particular bank.
This was the bank to go to. If you wanted to show your VC investors that you were serious about this, that you were a legitimate enterprise, you would sign up with Silicon Valley Bank. This is a key component, not only for venture capitalists, but for startup founders. So the disruption that could be caused here that's already happening is significant. This is a key piece of Silicon Valley, and it's really insane to see what's happening here today.
So where would they go now if they can't go there? What other options do they have?
Yeah, so people I've talked to, Mercury is kind of a newer platform that people are using. We've also heard Brex has seen some good inflows, and there's also other banks like First Republic Bank, that people are looking at. That there is some concern with that bank as well.
Hannah, is part of that we're trying to figure out, and I guess regulators are, was it carelessness? Was it risky investments? Was it the higher rate environment? Was it bad management? Was it just, an IPO market that's really dried up, a funding market that's gotten, closed up a bunch? Is it, or all of that?
I think it's really a perfect storm here of all those things. I mean, it was interesting. I did talk to one founder who said, I don't know if I necessarily blame the bank, but just the environment that we're in right now and the interest rates. Like this might not be an issue of bad management. It's just that the conditions have come together to really, create a failure here.
And how jittery, whenever you're speaking with your sources, I mean, we're coming off of what happened with Silvergate. Now you have this with SVB. Is it, what's next as far as when your sources, how concerned are they as far as where does this go from here?
Yeah, I mean, First Republic Bank, there's been a lot of chatter there that maybe this could be the next domino to fall. So, people are really buckling down. Founders are racing to move money. VCs are sending out constant guidance, keeping in touch with their portfolio companies. So it'll be interesting to see what happens next. But right now, people are buckling down for the weekend and hoping Monday brings better news from SVB.
You know what's interesting? I mean, this is a bank that's been around, is this right, from the early 80s?
Yeah, I mean, yesterday...
So it's gone through the tech bubble, the financial crisis. Go ahead. Yeah.
Yeah, so yesterday on the conference call that the SVB CEO did, he said, we've been here for 40 years. We need you to support us the way we've supported you guys through these decades. But honestly, people were spooked. They didn't like him repeatedly saying that they should stay calm.
Yeah.
And, this is the situation we're in now following that.
You're talking about CEO Greg Becker, right?
Yes, that is correct.
Something I was curious about, because you brought up First Republic, what concerns are there around that particular bank as far as why people would be kind of questioning that one as well now?
Yeah, I was talking to one person who kind of described it as SVB light. That there are these issues around their financial performance. Maybe there could be a potential for the bank run. I mean, obviously, this is all speculative.
Right.
But yeah, that's kind of where the chatter is right now.
Hey, Hannah, what does this mean, though, for the entrepreneurial sector and the startup community in Silicon Valley?
Yeah, I mean, I was just talking to one founder, they're early stage, and they're like, I've never seen anything like this. I'm new, I'm starting out. I don't know what I'm going to do next, and this is a huge blow. I mean, this is a really valued institution here. The fact that these financial problems are so severe is really shocking. I mean, the word I've heard used a lot is how sudden this all was. Yeah. And it's really, Silicon Valley has been rocked today.
I do wonder, too, if, was it late yesterday, Peter Thiel, right, his founders fund and some other high-profile VC firms, advising their portfolio companies to pull money from the bank. If they hadn't done that, do you think we'd be talking about this today?
It's hard to say, but it definitely contributed. And I know yesterday when I was talking to VCs that they were concerned about a bank run. They were like, I don't know if I should tell my portfolio companies or not to pull. There was a lot of mixed messaging being sent around, but the fact of the matter is that we're in a dire situation right now.
Hannah, we only have a little bit over a minute left, but I mean, you were talking about just the frustration of people that you have been talking to. I mean, what's kind of amongst the kind of craziest stories you've heard so far, just anecdotally, from who you've been speaking with?
Yeah, I mean, one person said, oh, I made a deal on Tuesday, put the money in and lost all of it Thursday.
Oh, wow.
Just walking past. Another person joked about opening up a bottle of Jameson. People are just pretty distraught here, and, it's quieted down now, but this morning there were quite a few people just trickling in and out, and, knocking on the door, looking for answers, trying to figure out, what they can do next and whether they can pay their employees.
Hannah, 10 seconds. What are you looking for next week? What's the next story? Yeah.
Yeah, I'm looking at how this is going to impact startups, whether people are going to have to fold, whether, VCs are in trouble. There's a lot to keep tabs on here.
All right, listen, so appreciate it. This was an important angle to get into this story, and so glad we were able to connect with you. Hannah Miller, she's digital currencies and venture capital reporter at Bloomberg News, rather busy right now, joining us on the phone from San Francisco. Carol Massar, along with Jess Metton, you're listening and watching Bloomberg Business Week right here on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yeah, it's 4:21 on Wall Street. I'm Charlie Pella. We check markets all day long at Bloomberg. SVB Financial Group is now seeking a buyer after regulators closed its Silicon Valley Bank unit, which buckled under the strain of declining deposits and losses in its securities portfolio. A source says the transaction might involve selling the company's assets piecemeal or as a whole, but the goal is to complete a deal by Monday. Wall Street shuns risk as bank jitters hit trading today. A losing week on the week. The S&P was down 4.5%. The Dow this week down 4.4%. NASDAQ on the week down 4.7%. A lot of red on the screen today. S&P fell 56 points, down 1.4%. The Dow ends the week at 31,000. 30,909, down 345 points, down 1.1%. NASDAQ down 199, a drop of 1.8%. 10-year yield 3.68% with a 2-year 4.57%. Spot gold up 2%, 18.68 the ounce. West Texas Intermediate crude up 1.1%, 76.53 a barrel on WTI. So again, recapping a down week, a down Friday. S&P today down 56, a drop of 1.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. See if your business is eligible for the Employee Retention Credit Assistance with the team over at Innovation Refunds. They help make the process easier and less stressful so you can focus on your business. To learn more, just head to getrefunds.com. All right, Carol Master along with Jess Menton, Jess, of course, in for Tim, who is on leave. I want to talk a little bit about the crypto space, if we may, because Bitcoin, I believe it's had its worst week since November due to the equity sell-off, fear over higher rates, and really an escalating U.S. regulatory crackdown on crypto, combining to hurt investor sentiment again. So we kind of continue to see this play out. I'm just pulling up Bitcoin for the week. It looks like it was down, I think, about 4.5% here.
Right, Carol, really getting under pressure, and especially when you're looking at just more broadly with this overall sell-off in the equity market. And really, as far as, cryptocurrencies, especially in recent months, it's been really hard. And so when you're seeing those segments of the market, especially those banks that had that exposure towards crypto, especially getting hit this week, Carol.
All right, so let's talk a little bit in our weekly crypto segment. Back with us is Mike Belshi. He's co-founder and CEO of BitGo, which, as the company notes on its website, is a digital asset security, custody, and liquidity company. Provides the operational backbone for more than 1,500 institutional clients in over 50 countries on institutions storing digital assets securely. He joins us via Zoom from Washington, D.C., especially appropriate since we want to talk a little bit about regulatory. Mike, good to have you back. Welcome again. Simply put, remind our world, our audience, about your role, your company's role in the crypto world.
Sure. So BitGo has been focused on custody most recently, which is it's a regulated custody. So we're regulated both in New York under the New York DFS as well as in South Dakota. Abroad, we're regulated under BaFin in Germany, in Switzerland, and also coming soon in a couple of other countries. So we've taken a highly regulated approach. We're trying to build market structure so we can build safe access to digital assets.
Something I was curious about is, from your vantage point, how is the recent volatility impacting the digital asset world right now?
Well, look, we're in a macro recession. Sometimes we hear a lot of focus, like just a few moments ago, about how the crypto industry has hit so hard, in the last month. And it's true, it has been. But, it's a high vol asset inside of a broader market, which has also been hit incredibly hard in the last 6 to 12 months. We're all experiencing, it doesn't matter whether you're crypto or otherwise, a pretty tough time as we try to recover from the ups and downs of first having had massive money prints a couple of years ago, and then now having massive inflation, Fed rates increase, and then also facing inflation fears.
So in terms of what you've been seeing specifically, whether through operations, conversations with clients, or what they're telling you, are you seeing investors more hesitant when it comes to crypto? Give us a little bit more color, if you will.
Actually, we don't see a lot of that. People are always wondering what's happening with the market. That's true. But there's a couple of different types of people that are invested into Bitcoin digital assets. There's those that are investing because they're speculative about potentially making a quick buck. And there's those that are here, and BitGo and myself personally are in this group. We're here because we actually do believe that we are building a better financial system. Look, technology has not had the opportunity to really change the financial structure that we have, the market structure that we have. There's a lot of middlemen, there's a lot of participants, there's a lot of folks on Wall Street getting very wealthy on the existing system. We have an opportunity to change that, make it more transparent and less risk. Now, I know it doesn't seem like that given the volatility that you see on a daily basis in crypto, but there are some shining lights that are coming through. And that's what we're here fighting for. It's not a 2-month effort. It's a multi-year effort. It's a multi-decade effort. And that's what we're here fighting for. In general, we see a lot of investors that are excited about that promise.
When you're talking about that transparency, what specifically is that? How do you make it more transparent?
Well, look, everything's on a blockchain, and that means every transaction through the dawn of time is recorded in a public way where you can always go back and see it. So we've already had the largest financial crimes ever found and investigated have been off of the blockchain, where what happens is some malfeasance happened in the past, and it may take a month, it may take a year, but you can watch what's happening. And as soon as a bad guy perpetrates, tries to exploit his past ill-gotten gains, you can see it and you can catch him. And that's transparency. On the balance sheet side, you can see exactly what assets people have. We have a product called Wrap Bitcoin, and you can go to a website and you can see in real time, 24 hours a day, 7 days a week, exactly what the finances of that particular product are. So you don't have to wait until the quarter and get 90-day out-of-date audits. We can give it to you every day in real time. That's transparency.
So how do we make the crypto world work, which I feel like, and I just said to Jess, I hate that we kind of say crypto world because there's a lot in there, and I feel like it's not apples to apples. We throw blockchain in there, and that's related, obviously, but it just doesn't all kind of mesh always in terms of comparison. But I do wonder, Mike, if the whole idea of digital currencies was to be kind of away from the traditional infrastructure with kind of less fingers in the pot, how does the regulatory environment come in there and kind of keep it pure the way it was meant to be?
Well, look, we do need some amount of market structure, checks and balances, elimination of single points of failure. A lot of the basic principles of security overlap with, like, how do you have sound money? So the idea that you give your assets or your cash to a single party and he manages it entirely without any oversight is a bad idea. Bernie Madoff made it very clear. He said publicly, if his clients had required him to use a third-party independent custodian, he could not have perpetrated this crime. So we know some of the basics of how to solve this. I recognize that in recent months, there's been a number of failures. And in general, it's not because Bitcoin is off and inherently rogue.
Right.
It's actually because Bitcoin has not been included in the financial system. And, we could talk about Silvergate Bank, where the entire burden of $1 trillion asset class's banking was basically laid to rest on the shoulders of Silvergate Bank. Now, what we should have had is, instead of a single bank with 85% exposure to crypto and a major concentration risk, we should have had 100 banks with 2% exposure to crypto. And this bank run never could have happened. So what we need quickly is for the U.S. regulators to get comfortable with crypto, to start welcoming it instead of shunning it and pushing it away, and making a robust market. That's what we need.
And I'm glad you brought this up, because we had this week with SVB, the biggest bank failure since 2008 when you're looking at what's happening in Silicon Valley. But to back up and think about what we've been chatting in recent months, FTX and that collapse leading into this. So what do you think was the big takeaway of what we should have learned from FTX's collapse as far as how this moves forward now?
Were you ever asked to be a custodian for them?
So we were not a custodian for FTX prior to their bankruptcy. We actually are the custodian under the new management. So John Ray has taken over as CEO at FTX. The first thing that he did was he installed a custodian to take care of the assets. Prior to that, the assets were held by the internal people working at FTX, and of course it allowed them to perpetrate crimes that we only learn about later. Look, the thing to learn about FTX is simple.
And again, we should point out, as we've been doing on Bloomberg, is they're still figuring it all out in terms of what actually happened and what criminal charges are accurate. So we just want to put that out. Go ahead, Mike.
Sure. Look, the basic thing we need checks and balance and market structure. FTX had two roles. It owned a company called Alameda Research, which was a prop trading firm. Some people call it a hedge fund. At the end of the day, that's proprietary money. It's investor money. It's high net worth people. Like, they can do what they want. They can take crazy risks. They want to lose all their money, no problem. The second part of FTX, of course, was the exchange. The exchange is part of market infrastructure. So when it comes to market infrastructure, where you're talking about the CFTC and derivatives, or whether you're talking about the equities world, you will see a series of companies: exchanges, broker-dealers, clearinghouses, transfer agents, custodians, and banks. And these come together to provide checks and balances and robustness, which prevent the types of failures that we had at FTX.
Right.
Unfortunately, without those in place, Sam Bankman-Fried took the money out of the exchange, which was supposed to be known, quantified risks, and infrastructure, and he took it and he put it in his prop trading firm.
Ken, they're just figuring out all the details, but I hear you. I hear you. Mike, we've run out of time, but I know we'll continue this conversation again in the future. Good to check in with you again. Mike Belshey, he's Chief Executive Officer of BitGo. He's also co-founder, I should point out, of BitGo, joining us via Zoom from Washington, D.C. But yeah, this is going to be a conversation. He's in D.C., and we know lawmakers are on it. They've got a lot to kind of figure out.
Yeah, this isn't going away anytime soon, so this conversation is going to continue for a while.
All right, let's get to Washington, D.C. and Nancy Lyons for World and National News. Hey, Nance.
Thanks, Carol. President Biden says the U.S. economy is heading in the right direction. He spoke today after another better-than-expected jobs report.
I'm happy to report that our economy has created over 300,000 new jobs last month, and that's on top of 500,000 jobs we added the month before.
Biden attributes the gains to investments that his administration has made, including in manufacturing. He also made another plea for House Speaker Kevin McCarthy to release a Republican budget plan. Treasury Secretary Janet Yellen has been on Capitol Hill today making her own requests of House Republicans. During testimony before the House Ways and Means Committee, she expressed real concern over the need to raise the debt ceiling.
Since 1789, the United States has always paid its bills on time, and it must continue to do so. In my assessment and those of economists across the board, a default on our debt would trigger an economic and financial catastrophe.
Treasury Secretary Yellen, Republicans have demanded sharp budget cuts in exchange for raising the debt limit. Democrats are already running ads for the 2024 race, and they're touting President Biden's economic agenda. Bloomberg's Nathan Hager has more from Washington.
The Democrats supporting American Bridge 21st Century Super PAC has purchased radio and TV ads that will air this weekend in battleground states Michigan, Pennsylvania, Wisconsin, and North Carolina. The commercials are timed to the second anniversary of the American Rescue Plan coronavirus relief. The tracking firm Ad Impact says American Bridge spent nearly $143,000 for the time. That's the biggest ad buy of the 2024 campaign so far. In Washington, I'm Nathan Hager, Bloomberg Radio.
At the Players' Championship, Christian Bezuidenhout and Adam Svensson share the lead at 8 under. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We check markets all day long at Bloomberg. A move lower today for the Dow, the S&P, NASDAQ. What a week. Let's begin with the weekly numbers. Lots of red this week with the S&P down 4.5%. The Dow this week down 4.4%. NASDAQ, as we head into the weekend this week, down by 4.7%. A renewed bout of volatility rattled markets around the world as SVB Financial Group's turmoil spurred concern about the next shoe to drop at a time when the Federal Reserve is deploying its most aggressive tightening campaign in a generation. As for the interest rate backdrop and the Federal Reserve, Christopher Zook is Chief Investment Officer at Kaz Investments, and he was our guest right here on Bloomberg Business Week.
The Fed is in a box. They're going to have to raise rates more. They're going to have to do it probably longer. And so as a result, it's going to make it much more difficult for investors to just ignore that.
Today, we had the 10-year at 3.69%, the 2-year 4.58%. Stocks lower across the board. S&P down 56, a drop of 1.4%. The Dow down 345, down 1.1%. NASDAQ today down 199 points, a drop of just about 1.8%. Spot gold up 2%, 1866 the ounce. Bitcoin below 20,000, 19,918 on Bitcoin, down 1.5%. West Texas Intermediate crude up 1.2%, 76.61 a barrel on WTI. DocuSign shares plunged 23% today after earnings. The e-signature company gave a first quarter billings forecast that was weaker than expected. Recapping 10-year 3.69%, S&P down 56, a drop of 1.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So everybody ready for a break from talking about banks and SVB and inflation and Fed policy and jobs? Are you ready?
I am. I definitely am.
All right, I am too. We want to talk a little bit about Apple because after a shaky start to the year, Apple's stock price has once again reclaimed the mantle of the go-to investment in big tech, even winning support from Goldman Sachs Group after years in which the brokerage refrained from recommending the stock. It is up, just pulling it up here, around 15% so far, actually 14% year to date, and up roughly 20% from a low in January. So let's do a roundup of all things Apple. It did hold, by the way, its annual meeting today. Back with us is Bloomberg News technology reporter Mark Gurman. He is in our LA bureau. Mark, nice to have you here with Jess and myself. So tell us about this shareholder meeting. What was on the docket?
Yeah, basically no fireworks at the shareholder meeting today, right? There were 9 proposals, right? Let me walk you through a few of them. So the first 4 were from Apple, right? And the second 5 were from outside shareholders. The Apple ones were pretty standard, right? Re-electing the board of directors, certifying Ernst & Young as their accounting firm, voting on executive compensation annually, and voting on new pay packages for the senior executive officers at Apple, plus Tim Cook, the CEO. Then there were the 5 outside proposals that had to do with enacting a new civil rights audit, an audit of Apple's ties and operations in China, more transparency around racial and gender pay gaps, another one about more discussion and communication between the board and shareholders, and then lastly, another proposal, a proxy amendment proposal for Apple to have more shareholders on the board, more outside shareholders on the board, right? Most Silicon Valley companies maybe have 1 or 2. Apple does not have any that are a shareholder elected director. Now, Apple said to vote in favor of the first 4 from them and against the second 5. And shareholders, the numbers actually just came out right before I came on here. Shareholders sided with Apple end to end. So Apple got everything it wanted, and it was a clean sweep for them today.
Something I was curious about, Mark, is especially when it comes to big tech and the layoffs that have happened in the past few months, when it comes to Apple, they're not necessarily having those types of issues that some of its counterparts are. What is Apple doing differently that maybe some of these other big tech companies aren't doing right now?
Yeah, that's right. Apple's not had widespread layoffs. They've had small layoffs having to do with contractors, right? They hire some contractors, people they pay on a contract basis for things such as Apple Maps, some retail corporate jobs and such. But in this case, they're not firing, full-time employees or laying full-time large groups like the other companies are. To how they operated prior to 2020.
All right, so I guess this explains why I can look at the compensation packages, and I kind of feel this way about a lot of executives, Mark. But I mean, not too shabby, right? $40 million for Tim Cook, some of the other guys, chief operating officer, finance chief. I mean, millions of dollars, and shareholders were okay. Is it because Apple's doing fairly well?
I think it's because they're doing fairly well, and I will tell you that this was actually a close one, right?
Okay.
If Apple kept the same pay package yet again for Tim Cook for the third year in a row, which is something close to $100 million last year and in 2021, I think maybe that pay package wouldn't have really passed, and Apple anticipated that. So what they did is they essentially cut Tim Cook's pay in half from something north of $99 million to around $49 million. Now, no one is going to cry for Tim Cook, right? When you're making $49 million, that's still pretty good. But clearly, they did that reduction there for a reason.
And looking, like Carol was talking about, its stock year to date up about 15%. And a lot of investors that I speak with, they tend to look at that as more of like a bellwether for how the economy is doing. So when you're seeing that holding up, and even this week, as far as kind of what this means for the broader market, I mean, where do you think that stock could potentially be headed? And are you seeing any sort of cracks there, or do you think it's going to continue to hold up pretty well compared to its counterparts?
I mean, Apple's really an outlier. I'm not sure it's certainly a bellwether for the economy because, they're doing, 15%, up 15% on the year. The S&P up south of 5% on the year, right? They're way ahead of their tech peers. So I think Apple's really in its own league in terms of people really believing in the stock as a long-term place to put your money. We're going into a very interesting product cycle for them, right? You're going to see the introduction of their first mixed reality headset. In the middle of the year, you're going to see big upgrade to the iPhone at the end of the year, and typically the stock rallies around that, right? Depending on what people are seeing out of the mixed reality headset, when that gets announced, Apple might get a nice boost there from some forward-thinking, future-forward investors. But certainly the iPhone, that's going to drive sales tremendously. This is going to be a big leap for the product. This is going to be the first redesign in 3-4 years. So certainly people are going to be looking towards that.
All right. Hey, one thing I'm so glad, though, that I knew we were going to have you on, because on Wednesday you put out a story too, Mark, on the Bloomberg and at Bloomberg.com about Apple shaking up sales operations to focus more on India growth. First time that India becomes its own sales region at Apple. I mean, are we seeing a significant shift in how Apple does business, away from China, more towards other places?
No, not really a significant shift in how Apple is doing business. What we are seeing is them really wanting to sort of flick that next lever and, right, really pull a new area of growth in, right? They did this with China over a decade ago, hugely successful. They now bring in north of $75 billion a year in China. It's time for the next growth story for Apple, and that's India. It is essentially a completely untapped market for the company, and now they want to put their best foot forward there. In terms of supply chain and production, what you're seeing is them sort of augmenting their operations in China, in India, sort of both a fallback plan and a way for them to expand manufacturing in new places. But this, much discussed shift outside of China, or out of China, I should say, don't anticipate that.
All right, got 25 seconds left here. Should I buy a new watch if I haven't bought one in a long time? Or is it going to be upgraded soon?
Well, if you're in the market for a new Apple Watch, I'd certainly buy one now.
Okay.
There will be new Apple Watches in the fall, but I'm not anticipating anything of significance. So either wait 6 months for a minor boost or just get the ones from September, I would say.
No joke. I've had a 3M sticky on my note, like, talk to Mark. Is it time to do this? Mark Gurman, thank you so much. Really appreciate it. Mark, of course, as you know, our technology reporter at Bloomberg News there in our LA bureau. Shares of Apple, by the way, finishing down just about 1.7% for the week overall, doing much better than the overall NASDAQ 100, which we saw a much more substantial decline. So good to check in with him. All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio. Carol Massar, Jess Benton. We got wine coming up in the next hour. Just thought I'd share. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. 4:53 on Wall Street. SVB Financial is seeking a buyer after regulators closed its Silicon Valley Bank unit, which buckled under the strain of declining deposits and losses on its securities portfolio. A source says the transaction might involve selling the company's assets piecemeal or as a whole, and the goal is to complete a deal by Monday. S&P 500 index moved lower today. We saw the S&P down 56, a drop of 1.5%. The FAA says Boeing can resume delivering 787 Dreamliner planes as soon as next week after resolving an issue that led federal regulators to issue a halt last month. The FAA said the plane maker has addressed concerns relating to the 787's forward pressure bulkhead. Gap shares tumbled today after the retailer reported quarterly sales that missed Wall Street estimates. Gap today tumbled 6.1%. And with more on the Gap story, here's Bloomberg's John Tucker.
Charlie, it's an indication the company struggled to attract shoppers during the holiday season, despite their deep discounts. Comparable sales, that's a key gauge for retailers, fell 5% in the fourth quarter, compared with analysts' average estimate of a 2.7% decline. Gap does expect the revenue decline to continue this year. Comparable sales declined at all four of the company's main brands: Gap, Banana Republic, Athleta, and Old Navy. The latter has historically been a growth driver for the company, but lately it has struggled. Charlie?
Bloomberg's John Tucker. Those are the company stories we're following this hour. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, more Business Week coming up with myself and Jess Metton. In the meantime, let's get another check on world and national news. Back to Nancy Lyons we go in our 99.1 studio in Washington. Hiya, Nance.
Thanks, Carol. The addition of 311,000 more jobs to the U.S. economy last month has been welcomed by President Biden.
The president suggested he hopes to see an equally favorable statistic when the Consumer Price Index is reported next week.
It means more people with good jobs and the dignity and security that comes with a paycheck. At the same time, take-home pay for workers has gone up, and while we still have more to do, and there may be setbacks along the way, inflation is now down 30% from what it was this summer.
The president said he was most pleased by the reentry of more workers into the labor force because he said jobs are available and they are more optimistic. In Washington, Irv Chapman, Bloomberg Radio.
The collapse of Silicon Valley Bank is getting attention on Capitol Hill. Treasury Secretary Janet Yellen commented today on the threat to regional banks.
There are recent developments that concern a few banks that I'm monitoring very carefully.
Yellen says it is and should be a matter of concern when banks experience financial losses. She made those comments to the House Ways and Means Committee before California regulators confirmed the bank's collapse into FDIC receivership. Another day of severe weather in California. Heavy rains, damaging winds, even snow has swept into the state. Mike Keever is Caltrans Chief Deputy Director.
This heavy, warm rain combined with accumulated snowfall is leading to the risk of flooding, rock, and mudslides.
Keever says in the last month they've cleared enough snow to fill 100 Rose Bowls. And now the latest from the Players' Championship in Ponte Vedra Beach, Florida. Christian Bezuidenhout and Adam Svensson share the lead at 8 under. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol and Jess.
All right, much appreciated. Thank you, Nance. Well, Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. They may be able to help your small to medium-sized business qualify for ERC assistance. So what's the ERC? It's a tax credit for the sacrifices businesses made for keeping employees on payroll during the pandemic. Let Innovation Refunds help you grow your business. They do not get paid unless your business receives its refund. Learn more. Just head to getrefunds.com. Well, March is Women's History Month, and every day this month we are celebrating significant moments in women's history. Let's get your installment for this Friday, March 10th, 2023. For that, here's Bloomberg's Lisa Mateo.
On this day in women's history in 2015, Los Angeles celebrates Susan Ann Cuddy Day. She's the first Asian American woman to become an officer and the U.S. Navy's first female gunnery officer. But getting into the military wasn't easy. During World War II, mainstream culture in the U.S. grouped all people of Asian descent together, and Cuddy's application was rejected because she was, quote, Oriental. That didn't stop Cuddy, whose father was an outspoken supporter of Korean independence from Japan. Her application was accepted when she reapplied. After the war, Cuddy defied interracial marriage laws in Virginia by marrying a white man on base. She became an intelligence officer, breaking codes for the Navy, and later joined the NSA. After serving her country, Cuddy retired and dedicated her life to activism. Susan Ann Cuddy died in 2015 at the age of 100. That's today in women's